Hey everyone, and welcome. Today we're diving into something called the passive investing paradox. It's a fascinating story about how the world's most popular and honestly most successful investment strategy might just be sowing the seeds of its own instability.
I mean, think about it. This is a strategy that has literally saved millions of investors billions of dollars in fees. But what if its incredible success is creating brand new, totally unforeseen risks in the market? That's the big question we're going to tackle today. All right, so to really get the paradox, we first need to hop in the time machine and go back to the world before this whole passive revolution kicked off. This was the age of picking winners. So back then, you had two camps. On one side, you've got active management. You can think of this as the skilled artisan, right? The brilliant stock picker trying to find those hidden gems, timing the market just right to beat the average. And on the other side, you've got passive management. This is more like an efficient robot. Its only goal is to perfectly match the market's performance by just, buying everything in an index like the S&P 500. The big problem with that artisan approach? Man, it is expensive. And that expense really boils down to this number. See, paying for all that brain power, all that research and trading, it costs money, about 0.57% on average. Now, that might not sound like a lot, but believe me, year after year, it acts like a giant anchor, a direct drag on your returns before you've even made a single penny. And this very cost, it became the problem a revolution was built to solve.
Yeah, that high cost became the spark for a revolution. And it was a revolution built on a surprisingly simple idea its founder called immutable arithmetic. And here's the core philosophy, right, from Vanguard founder John Bogle himself. He basically argued that the market's total return is like a fixed pie. And since all those active managers are the market, it's just mathematically impossible for all of them to beat it. So once you subtract their higher costs, they have to, as a group, underperform. It leads to this simple, powerful conclusion. You can't control what the market's going to do, but you absolutely can control what you pay.
So Bogle put his money where his mouth was, launching the first index fund for regular folks like us back in 1976. And the reaction from Wall Street? Oh, it was not great. They called it un-American, a guaranteed ticket to mediocrity. But as we're about to see, this simple math was definitely on Bogle's side. And that brings us to today, and the incredibly powerful, low-cost tools that this revolution has put in the hands of pretty much every single investor.
So why did this idea that everyone laughed at become so completely dominant? Well, it really comes down to these four pillars. We already talked about cost, but passive funds also give you amazing tax savings. You get instant diversification by owning hundreds of stocks at once, and you get predictable performance. You know for sure you're going to get the market's return, minus a teeny tiny fee. Today, these benefits come in two main flavors. You've got your traditional index mutual funds, and you've got exchange-traded funds, or ETFs. Now, they both track an index, but they work a little differently. Mutual funds only price once a day, while ETFs trade all day long, just like a stock. But it's that last row, tax efficiency, where things get really interesting. And look, this isn't just some boring technical detail. This difference in tax efficiency is what gives ETFs a kind of structural superpower, especially if you're investing outside of a retirement account. Okay, so here's how it works. With a mutual fund, if a bunch of people sell, the manager has to sell stocks to get cash, and that can trigger a capital gains tax bill for everyone who's still in the fund. Not cool. But with an ETF, big institutions can just swap their ETF shares for the actual stocks. It's a trade, not a sale. No cash ever changes hands inside the fund, so no capital gains get triggered. It's just a beautifully elegant tax shield. And this, right here, brings us to the core paradox. The unbelievable success of passive investing, this triumph of low-cost efficiency, well, it's become so massive that it's now changing the very fabric of the market itself. So, to understand the risk here, we have to talk about a concept called price discovery. This is all the hard work that active investors do, digging into companies, judging their future, and deciding what a stock is actually worth. Their buying and selling is what sets fair prices across the market. Now, passive funds, by design, they don't do any of this work. Not a lick. They just buy whatever's in the index at whatever the current price is. And this makes them, basically, free riders. They get all the benefits of an efficient market without doing any of the work to keep it efficient. They're relying on a smaller and smaller group of active managers to keep prices honest. This leads to a really important consequence called inelastic demand. Here's how to think about it. Passive funds are price insensitive.
They have to buy a stock when it enters an index, and they have to sell when it leaves, no matter what its fundamental value is. This means a stock's price starts to have less of an impact on their trading, and that can disconnect the price from how the actual business is performing. So what's the danger? Well, when tons of money flows into an index fund, it lifts all the stocks in that index at once, kind of like a rising tide lifting all boats. Companies start moving together, not because of how they're doing individually, but just because they happen to be in the same basket. This makes everything more correlated, and, ironically, it starts to chip away at one of the main benefits of passive investing in the first place: diversification. So as you can imagine, this has started a huge debate among academics. They're looking into whether these automatic index rules are creating momentum bubbles, whether all this coordinated buying and selling could make a market crash even worse, and even whether the biggest index funds, by owning huge chunks of competing companies, might be accidentally hurting competition. These are really complex systemic questions, and there are no easy answers. So, where does all this leave us? I mean, how are we supposed to balance the obvious benefits for us as individuals with these bigger systemic risks that are starting to pop up? Well, it all really comes down to this trade-off. For you, the individual investor, passive investing is still a mathematically proven, super low-cost way to build wealth. No doubt about it. But for the market as a whole, its sheer dominance is becoming this powerful force that might be making prices less meaningful and maybe making the whole system just a little bit more fragile. Which leads us to a final thought to chew on. The index, it's the map, right? It's a representation of the market territory. For decades, active investors were the explorers, the ones out there charting that territory and making sure the map was accurate. But what happens to the map's reliability when almost everyone stops exploring and just decides to follow it instead? And that right there is the paradox of passive investing. The absolute smartest strategy for you as an individual is collectively changing the entire game for everyone. It's a paradox with no easy answers. Thanks for watching.